Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I am your host, Hannah Chapman, and it is Friday, April 25th, currently 1:23 p.m. Eastern Time, and it is another installment of Investment Friday. I am here with my good buddy, Brad Haines, Chief Investment Officer of Juncture Wealth Strategies. Brad, did you have a good week last week? We were off. We didn't record on Good Friday.
Correct. Yes, it was a pretty good week. I was in Arizona in our other office, working out of our office, meeting with a lot of clients, um, allaying fears, hopefully to a certain extent, but also positioning their portfolios to deal with the current uncertainty that is existing in the U.S. economy and in the global trade order.
Mm-hmm. Yep, it's been quite a roller coaster, right? I mean, over the last, especially the last 2 weeks. So we're gonna kind of dive right in to that because so far this week, again, it's Friday, about 1:30 p.m. Eastern. Markets will be open for another couple hours. Um, but so far, we have a positive week on the books where we have not had that for several weeks in a row at this point. So tell us a little bit about why are the markets up this week? What's going on? And then we're going to dive into some of the fundamentals that we're actually looking at.
Yeah, so a couple things happened this week. If you remember the week prior, President Trump had intimated that he thought Jerome Powell was behind the curve, couldn't wait to get rid of him, that kind of thing.
He put out
And
some pretty strong language on Truth Social about
yeah,
him.
which he's known to do. Um, so because of that, that disrupted a little bit of, of investors saying, hey, whoa, if he gets rid of the chief monetary strategist, if you will, for the United States and really for the world, for a lot of the world, um, that that increases uncertainty to a significant degree. And so a lot of people were concerned. And so that led to some sell-offs. Well, he came out this week and said, no, I'm not looking at getting rid of him early. His term expires in May of 26. He'll serve out the full term. Um, and we're having trade deals with, in the process with India, Japan, and China. Um, and so because of those relaxation of terms, particularly in regards to China, where he said, hey, I might lower these tariffs quite a bit as an incentive, to help China or Beijing know that I'm serious about us working together. Um, Now that has relaxed the uncertainty a little bit. Investors kind of caught a wind, and the equity markets have rallied pretty significantly this week. Now, the reason I'm going to hedge this a lot in terms of what I'm in terms of my thoughts here is because nothing has changed. In fact, Beijing came out this week and said we have not had discussions with the United States. In fact, we haven't even started discussions with the United States. Japan's comments, a couple Japanese policymakers came out and said, hey, we're not going to structure a deal that's against China, as China does more trade with Japan than the US. So they're not going to risk that trade relationship for our trade relationship. So there have been some pretty hard comments from other countries towards the US in terms of trade. So to me, uncertainty is still here.
Mm-hmm.
There's absolutely nothing new that we knew this week than we did last week. And yet it seemed like the equity markets wanted to have a reprieve and investors just got excited about it going up in value. Now, I would say that this is trading very, very much like these patterns, very much like a bear market, where you have sharp rallies into a declining trend.
Hmm.
So that's where I think we are. Many times in bear markets, you have the sharpest equity rallies, which I know seems very counterintuitive, but it's within a longer term downtrend. And that is where I believe we are. If you noticed, a lot of companies have come out over the past 2 weeks and said, hey, because of the uncertainty, we are suspending forward guidance, which means they're not going to give analysts a projection of anything in their business because of the uncertain nature of of the economic policies coming on the Trump administration. Well, if there's no forward guidance, that means sell side analysts, buy side analysts can't really have a logical foundation upon which to base their earnings per share forecasts.
Hmm.
So right now you have a spot where the S&P 500's forward earnings are stale and out of date. So there's a lot of people that are relying on them and they shouldn't, because those are not indicative of the current thinking. That is indicative of the last known, the last time they could have confidence in that forecast, which that does not include the tariffs. So to me, I think we're investors are using stale data. They're like, hey, look, the earnings per share is still pretty high for the S&P 500. That is absolutely not the case. They just haven't been updated. In fact, right now, I think the S&P 500 is trading at 19.9 times forward estimates.
Okay. And
Now,
then, and we've talked about PE before, price to
yep.
earnings ratios, but let's just do a quick reminder of what that means.
Yeah, so a PE ratio is the share price divided by the earnings per share. Okay, it's basically how many dollars are you paying for $1 in earnings for these particular companies. It's just a valuation metric. It just gives you an idea. You can compare different companies to each other based on that ratio. It doesn't necessarily say it's good or bad. It just tells you what's more expensive and what's less expensive relative to earnings. And so, generally speaking, you want to pay the least amount for earnings that you can. Now, there's lots of nuances around that, where there may be times you want to pay up for really good companies because those companies are valued more highly because they are better than these other cheap companies. So there's some nuance there, but it's a basic valuation metric. Um, and Bank of America's research group just came out and said, look, over the past number of years with globalization and the efficiencies in that trade system, um, companies have earned much higher returns because they've been able to lower their costs on a percentage basis. They said, we think that is now turning around, and we think PEs on a structural basis are going to go down,
Mm.
which means if you're paying 20 times, that used to be kind of considered the floor. And they're in B of A's estimation, they're thinking that might be the cap, the highest return or the highest PE that the equity market, the S&P 500 trades at, given all of these reverse globalization trends. Now, again, they also caveat it and say, we have the AI trend and innovation, and that also can help support margins as well. But they think that there's a timing issue here. AI may not be substantially helpful in the next 12 months, which is
Right.
when the tariff and all those types of things are happening. But 3 to 5 years out, it may have a dramatic ability to rationalize costs in a company. So it's just something that we have to watch out for. Um, Also, we essentially have until July until we have the reciprocal tariffs coming off, okay,
Right.
or
That was
being applied.
the 90-day pause that went into effect a couple of weeks ago, right?
Yes, yes. So that 90-day pause, we're working through that. And I think President Trump is under a lot of pressure. Um, a couple things have happened. So one, there was no pause on China, and
Right.
China is one of our largest trade relationships. As we've all known, China makes a lot of the goods that we as US consumers purchase. Well, when those tariffs went to basically 150%, that effectively shuts down most of the trade from China. Okay. Now that doesn't seem like it's that big of a deal. 150%, except that it's effectively almost a trade embargo because it does wipes out their cost efficiencies. And so what happens is US businesses stop ordering from China because now they can get it somewhere else. Or if they can't get it somewhere else, maybe they've already built inventory, which we saw a lot of that in the first quarter and the fourth quarter of 2024 and first quarter this year is a lot of inventory building because they were anticipating the tariffs. Well, if Trump came out today and said, hey, we're going to get rid of these tariffs completely on China, let's just say we're going free trade because it's already disrupted for a couple of weeks, the trade with China, there's already a supply disruption coming in goods from
Right.
China. Okay. It takes 30 days for a cargo tanker to get from China to the United States, and that's on the West Coast ports. Well, it takes 30 days. So we haven't even started to see the scarcity of goods that could be coming over the next couple of months simply because we have had these tariffs on for a couple of weeks. Now, if for whatever reason this goes until July, this means the second half of this year, you might actually go into stores and they might not have the goods you need. Okay. They might have some, but they might not have very many of them. And the
Right.
prices will be substantially higher regardless of the tariff. Tariff's obviously one factor, but the prices are going to go beyond the tariff because of the scarcity of goods that will be available. So, how much does that add to inflation? I don't know at this point. At this point, it's people are estimating somewhere between 1 to 2% in the CPI, which right now is fine because we're at a pretty low, still we're at a pretty low level of inflation. So you add 2%, we might get to 4 or 5% overall inflation at the peak. Again, this is a one-time hit until supply chains can adjust. The problem is the supply chains take years to to rationalize or to change. It's
Mhm.
not like a within a couple of months you can have a factory up in China or excuse me, shut one down in China and start one up in Indonesia or somewhere else. So it's something that is very, very important that people recognize that this is a longer term process, not just a short term process.
Yeah, some of the things that I've been reading and seeing in that regard, are that we're getting empty shipping containers at the ports, right? So the goods that we typically get from China, we're already seeing some of that. And to your point, it's going to continue to compound over the next several weeks until we have more clarity. And the fact that Beijing is not backing down the way that Trump wants them to. He's the rhetoric he's come out with this week is that we're going to be nice, quote unquote. We're going to be nice. We're not going to play hardball, or the things that he's saying. And frankly, I think that's because he tried to come out swinging, and it didn't go in his favor. Right? China came back with like, all right, we're going to do 125% tariffs on your goods then,
Right.
and we're
It,
not taking those off.
no, and the problem is it now shows Trump has shown his hand And China's like, we can go as long as you, we can go a long time if we can just start trading more with Europe. Europe does not spend nearly as much as the US consumer. However, um, with the rebalancing of the trade order, one of the effects, one of the impacts is that the US consumer has to save more.
Hmm.
They can't spend the same amount as they have in the past 30 or 40 years. They literally have to save more because when you have a trade deficit, the same thing as you have an investment surplus. Okay. And that investment surplus is what has has founded companies. It's what grown earning. It's part of our innovation wave of commercializing new technologies. All of that is an investment surplus that we've received from everywhere around the world. Okay. Well, if you now want to start trading, you want to shift that. If your trade deficit, let's say, goes to zero, so now you're neutral. You export and import the same amount of goods to every country on the world, which is never going to happen, but let's just say it does. Um, that investment surplus goes away, and you need to self-fund a lot of that investment, which means U.S. consumers have to start saving more and investing more, and that's where the funds will come, and that will become much, much, much more difficult for uh, companies to find funding, which the past 40 years has been pretty, off and on, but pretty good.
So I've heard this concept a couple of times, and I'm having like I'm having a little bit of trouble fully understanding what that means. I mean, I've heard exactly that, that if, we are the ones who are in the trade um, deficit, technically, right? Like we're bringing in more goods and other people aren't buying our goods as much. Then it's also being funded with debt.
Yes.
That's the other concept, the way that I've heard it. And so there's somehow my brain isn't like it's not clicking fully. So I'm wondering if you can
Who's
say it
funding the debt?
yeah,
Think,
say
think,
it a different way.
yeah, let's say it a different way. So yes, a lot of it's debt. Okay. And who is funding our debt?
Other countries, China, Japan, Canada,
Yeah, 20 to
right?
30% of US corporate and US Treasury debt is funded by foreign countries, okay? Whether it's private individuals, institutions, or government entities. Between all of them, it's about 20 to 30%, depending on the market. So, for example, the US equity market, $17 trillion out of $93 trillion of value is funded by international investors. That's just in public equities. So, who's going to replace that? Because if the US dollar weakens, international investors will start to reduce. They may not sell, Harry Carry, they might not go crazy and sell all their holdings, but they will limit new purchases. And let's be very careful about that. New purchases is what will drive the market up or down.
Mm.
Okay. So now if they restrain their new purchases in US equities because they're going to go to Europe, they're going to go to Asia, whatever, then the US investor has to step up to take their place, or the equity markets will fall. Okay.
Yeah,
Because
okay.
you have same amount of value, less buyers. The natural course is to have it fall a little bit more, which means future equity valuations, future equity returns in the United States may not be as great as they have been the past 20 to 30 years. Now, that's not to say after all of this gets adjusted, okay? So let's look out 5 to 10 years. Supply chains for critical goods have moved back to the US. Um, the trade agreements have been updated to reflect the fact that now we're manufacturing more at home. It's not to say it can't be a really good and more stable world for the United States, but it's not going to happen in the next 2 years. It,
Right.
it, it takes a bit of time to have this take place. So what I'm saying is over the next number of probably 5 years, the expectation is as U.S. equities probably shouldn't be um, as advantageous as other countries, particularly if Europe starts to invest more in their own capacity, their own defense, their own. That is a fiscal impulse that will stimulate their economy to a very large extent.
So when we're looking at potential, the next few years for sure. So I mean, a lot of what we've been focused on recently has just been like present moment, like what people are experiencing because it's been wild, right? I mean,
Yeah,
it's been very
it's been
volatile.
wild. That's a good
It's just
description.
right. I mean, like just to not sugarcoat it, right? Like it's been wild. Where the uncertainty, again, we've harped on uncertainty for months now, but it's true, right? That we don't know. We don't know what the tariff situation is going to look like tomorrow. We've got this 90-day pause, but any time within that, something else could happen or things could shift. There's so much uncertainty there that it's hard for companies to plan, right? Hence the no forward guidance for right now, which what does that look like? What I've told my clients recently is that, like I don't know what it's going to look like at second quarter earnings. When we start getting even first quarter earnings are starting, are coming out now. First quarter earnings are coming out. We're going to start to see some of those effects. Second quarter earnings, we might have another shakeup because everything that's been going on is going to show up in the earnings.
Mhm.
But we don't see that yet, right? The earnings tell us what happened last quarter, and then the stock market predicts what's going to happen next quarter and the quarter after and next year. The stock market is a leading indicator, right? Like that's the best way that we can describe it. It's a leading indicator of what investors think the economy is going to look like down the road.
Yep.
It's
6 to 9 months out. It's telling you what they think the economy is going to do.
right. And so when we look at it from that lens, it's again, we're having all this volatility. We've got big spikes up, big drops down over the last, couple months here because nobody really knows, right? That's just the market is literally signaling to us, we don't know. Maybe this. Oh, wait. Something else came out. Nope, maybe down. Oh, good news, maybe we're back up. Oh, bad news again. Oh no, we're going back down. Right? It's like it feels um I don't know what the right weather term for that is, but it's just like
It's bipolar, is what
yeah,
I consider it. It's like it's either we're super depressed or we're super elated.
right.
It's really nothing in between, which normally it's in between, right? Um, and that's why I think it's trading like a bear market where you have within a downtrend, you have these big rallies,
Hmm.
and people always underestimate those bear market rallies. Bear market rallies can be 10 to 15% from the bottom to the peak of the rally, but it doesn't mean you're in a bull market. It falls back to earth and actually establishes a lower low. Part of the reason I'm saying this a lot because I think people need to understand this, that whether you buy more or not really depends on your time horizon.
Hmm.
So if I'm a young investor, meaning an investor who is not retired, they're still working, I would think this is the best couple of years for you to accumulate to accumulate more stock assets. Okay.
Hmm.
So it may seem contrary to what I just said, but because your time horizon is longer than 5 years, use the next few years to accumulate as much stock as you can so that when it does kind of take off on a more stable footing, you can benefit from that uptrend. um you know um so if you are living on your portfolio, that's something you need to take a look at. There's a lot of really great companies right now that, because of the recent sell-off, are paying dividends of 4 to 5% or more that are probably probably they're going to get hurt in the tariff discussions. They just are, but they're not going to be hurt enough to reduce that income by much. So it's something that if you want to, you know, if you're going to invest in stock for inflation because you're 70 years old and you have another 15 years, 20 years left, and you get 4%, you only need to earn 6% on that to make that equity return of 10%. So you don't need to rely on capital appreciation nearly as much as you have in the past. There's a lot of really good companies out there like that.
Mhm.
Um, if you are starting to look at going into retirement, be patient. Try to diversify, try to get into the right situations. I've had conversations with a couple clients, when is the right time to start buying stock? And I'm like, there is a right time. It's not right now,
Right.
but we're actively looking for really, really good opportunities to invest in good, large dividend paying, very, very solid companies that are going to be very inexpensive at some point. And so we're very excited about those, buying some really, really good companies with some good technology bent for the next 10 years. And so I'm very excited about those possibilities. Um,
And to continue on that a little bit, right? So we're talking again, present moment, lots of volatility. Next 2 to 3 years is still really unclear for the most part, like as far as like what we're actually going to be experiencing, because if we do have some big supply chain disruptions, I mean, we experienced that in 2020, right? Those supply chain disruptions took an entire year to move through until we were like finally starting to feel a little bit normal again. And so if we have similar issues with the supply chain with goods, with bringing goods into the United States, it's going to take a while, right? So that's where that thought for me comes in of like, all right, maybe another 1 to 2 years, we're going to be dealing with something related to what we're going through right now. But beyond that, right, the long-term prognosis is still for bigger growth in general, based on everything that we've talked about before, AI, different healthcare, things that are coming up. We're like really cool technology and personalization trends that are happening. But beyond that, the other question I was going to ask is, what does this start to do looking at international stocks? You alluded to it a little bit, but for, gosh, maybe 20 years now,
oh,
internationals have been like US stocks, US
dominate.
equities, yeah, have been dominating the global investment scene for a long time, 25 years, maybe even.
Yeah, probably.
Um, to where, we used to, international stocks used to be like a core piece of a portfolio. And over time, like I've had clients who say, just give me US stocks and I think we'll be fine forever. So is that starting to shift? Is that a conversation
Yeah.
we're going to have to start having?
Yes, yes, we are. And part of it depends on really upon Europe and what they do in terms of their fiscal impulse. I mentioned that a little bit about their increasing their defense spending. And that's primarily due to Russia's invasion of Ukraine and Russia's kind of um, hybrid attacks on other countries in Europe. They blew up, some pipelines. They've done some sabotage in some other European countries outside of just Ukraine. Uh, Poland, Germany, um, I think Belgium, and for certain Estonia and the Baltics have all felt, and Sweden have all felt Russian attacks. Okay, whether they were, you know, uh, covert or overt, it very much on the covert side, but they have experienced it, so they are very motivated to start spending on defense related expenditures. Now, when that happens, excuse me, when that happens, that generates economic growth. That's
Mhm.
a massive amount of economic growth. In fact, in Germany, which has been very pacifist in its nature since World War II. They just their new chancellor is coming in and saying, "Hey, we're going to spend 500 million or 500 billion euros on German defense capabilities." Now, that is enormous amount of money for Germany to spend, and that means they're serious about rearming, they're serious about their defense. What the economic spinoff from that's going to be is massive.
Hmm.
Okay. It's going to generate a lot of economic growth. And in that economic growth, that is going to drive earnings of their banking, their manufacturing sectors, their transportation sectors, all they're going to use more of everything. It's going to go all the way back to they need more steel, more aluminum. They need more, I mean, really basic stuff. So it's going to be a big deal. But again, you have to wait to see if that's implemented and what other countries step up. Is Spain and Italy and Greece going to do the same thing? I know Finland has been increasing their, Poland has been probably the premier example of how their economy is growing quickly, partially because they're rearming. Like they are really investing a lot in their defense capabilities. So all of that is going to generate a lot of economic growth, particularly as they kind of come together a little bit more to form a united front versus Russia. So we'll see if that gets implemented. If it does, I think Europe is going to be really a core part of a portfolio going forward. Now, they still have a lot of problems within the union in the sense that they still have a lot of different laws, different cultures, different ways of viewing things. And so it's kind of a loose agreement almost. So you have to be careful that you don't uh overestimate the amount of equity price appreciation there. But I think it will become more of I think it'll be more of a competitor with the U.S. in terms of equity market performance. Um, One thing I also wanted to mention within the US, if people want to stay more US centric, is when we see these supply chains start coming back home, there's a couple of things that you could look at as a second confirmation. And one is real estate. I know that sounds really weird, but uh, really manufacturing and logistics real estate are going to be really sought after. Truckers, railroads, they're all going to be really necessary to grow that part of the economy. So if you see big manufacturing plants being put together, well, those manufacturing plants are going to have distribution. They're going to have logistics and trucking, or railroads. They're going to have distribution centers. So all of those go towards there are certain pieces of real estate that are very undervalued right now that people could step into and really benefit from the growth of that part of the economy. Again, I would not invest at this juncture right now. I would wait to see how the tariff discussion happens and to see confirmation that those companies are beginning to move back their manufacturing sites to the US.
Last thought here, wouldn't that also necessitate, and this is part of the discussion and the pushback that I've been seeing for bringing back a lot of manufacturing, is that China invested billions upon billions of dollars in their infrastructure, right? And so all of like railways, roadways, everything, like we've known for a long time. Bridges. I mean, I live in Cincinnati right now, right, where the Brent Spence Bridge has been in disrepair in one way or another for decades now and needing to be replaced. And the funds haven't been appropriated to do so. And so wouldn't that require a really big infrastructure push from the federal government, like coming down from the federal government, so that we can have, again, the certainty that if we bring our manufacturing back, we'll be able to get over the bridges to literally to
Yes.
truck things around.
Yeah, you're absolutely correct. We have a decaying in the United States, we have a decaying infrastructure that needs to be renovated and needs to be expanded if we want to bring our manufacturing plants back. One is the electrical grid. Okay.
Hmm.
Um, very, very large plants can co-locate their electrical generation. Okay. So I'm not discussing very, very large plants, but I'm talking about shops that need to be connected to the electrical grid, and they need electricity to be generated, and they need to be able to have stable base load electrical current whenever they need it and the amount that they need it. And so that electrical grid is so old and so decaying that it needs to be redone almost. There's a large part of it that needs to be done much, much more efficiently than it currently is. So to your point, yes, it's not just the roads, the bridges, the railroad tracks, all of those things need to be, whether the federal government pays for it or whether they incent it through tax breaks or whatever, it needs to be done. Now, we can start this process prior to those improvements, but as we grow a manufacturing economy, more and more pressure is going to be brought on Washington to make those type of investments, which, to be honest, we've needed to do for 20 to 30 years. I mean, how many bridges have we heard almost collapsing or collapsing in part? And that's because of poor maintenance. And so sometimes, you can't have a bridge that just you build once and forget about it.
Right.
You have to have ongoing maintenance. And unfortunately, cities, counties, and the federal government and the states have decided, well, maybe we can cut every couple of years on that. And sometimes that doesn't work. So,
Yeah. Well, as usual, we have so many other things we could talk about. So many topics that are touching. I'm thinking about student loans recently as well, and how that might affect the economy when those start being back in
paid
full
off.
force. Yeah, paid off without the benefit of income-based repayment plans. Right, there's a whole bunch of stuff coming through there that can affect the American consumer as well. But
Well, let me make one last comment.
okay.
Okay. The word recession is starting to come about quite a bit in the narrative, in the media, and those types of things. And that can be scary for a lot of people to hear. And I just want to remind everyone, recessions are a normal part of the business cycle. Um, they almost are as important as the expansion part.
Mhm.
Okay. They're not as much fun to go through. That is for sure. And it will disrupt people's lives because for example, if your job is in the trade sector, you're one of the 34.7 million people employed in the trade sector. There's a certain number of your friends or family or yourself that may be laid off. Okay. Their jobs eliminated because we don't need that many people in that space anymore. That is going to be devastating for them, but there will be other jobs available. Right now, we still have a lot of jobs available. So, uh, recessions are a normal part of the business cycle. It's nothing to get too concerned about. It's nothing to panic about. The equity market, if it goes down in the long term or it goes down in the short term, don't necessarily worry about it. If you have a longer term time horizon than 2 or 3 years, don't worry about it as much. It's not going to impact you as much as you would think. If you're living on your portfolio, use this as a time to upgrade your portfolio. Get more income oriented stocks. Look at some bonds. Maybe you should have a little more in the bond space, generating those higher coupons with a lot more security than equities. Those are some things that you can be doing to help you get through the next 2 or 3 years of kind of rough patch. Um, but again, I think the US has a really good future, even though I know I said some things that were a little more negative. I think if you stick with your financial plan, you'll wind up hitting those goals.
Hmm. And on the business side as well. I mean, I work with clients consistently, on a monthly basis, looking at how they are creating revenue and generating income in their business, how it's working, what's working, what's not. And so being able to, as a business owner, being able to pivot when things are shifting, right? That's if I've seen anything over the last, almost 20 years in this business, it's that the people who are able to pivot, people who are able to meet the moment, and meet their clients, meet their customers, where they're at in a different way as the economy changes, those are the businesses that continue to grow and continue to thrive versus the same thing we've been doing isn't working and we're just going to keep doing that until we go bankrupt, right? Like you can't do that. You have to meet the moment. So yeah, from both sides of the spectrum, whether it's investment or how you create your income, there are still opportunities and we can still uncover those opportunities together if we know what we're looking for and we understand you and your business and your goals well enough. So we're good. That's it for today. If you have any questions, as always, we love to hear your questions. We love to respond to them, especially in times like this. If you're noticing things and you're like, well, what about, this thing, or I'd like you to talk more about XYZ thing that you mentioned, send us a note. Send me a DM on any of the platforms that you find me on, or send us an email. Everything is in the show notes, to be able to grab that. And otherwise, just hold on. We'll see what next week brings. Right, Brad?
Sounds good.
Thanks. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.